Okay, let's set the scene. It's early February 2026. You're trying to pilot the US economy, this massive, multi-trillion-dollar airplane, but all of your instruments have suddenly gone dark. That is exactly the situation that policymakers are in right now. They are, quite literally, flying blind. Today we're going to unpack exactly how we got into this data blackout and what it means for all of us.
So, what's the big mystery here? Why are the people in charge of steering the economy, the Federal Reserve, major investors, suddenly missing all their most important information? Why are they flying blind?
Well, it's all because of something called a data blackout. And this isn't just some minor hiccup or small delay. We're talking about a complete suspension of the key government data that our entire financial system relies on. Without these official reports, policymakers are forced to make these gigantic multi-trillion-dollar decisions based on, well, basically on guesswork.
So let's start our investigation. How in the world did we end up in this information vacuum in the first place? It's really a domino effect. It all started with that record-breaking 43-day shutdown in late 2025, which already made a mess of all the data. Then, just when things were kind of getting back to normal, bam! A new partial shutdown hits at the end of January. And even though it only lasted a few days, that was enough. It stopped all the data processing at the worst possible time, forcing a delay of the most important economic reports.
And this is the economic dashboard that has just gone completely dark. Look, we're not talking about minor statistics here. The jobs report, our best look at the job market, and the inflation report, which tells us how fast prices are rising, they're both offline. These are the gold standard numbers. Without them, it's like trying to drive a car with no speedometer and no fuel gauge.
Okay, so with the official dashboard offline, we have to turn to other clues. And that brings us to part 2 of our investigation. The really strange signals that are coming from the jobs market.
The very first piece of private data that we got during this blackout was from the payroll company ADP. And the number, well, it was a shocker. A gain of only 22,000 jobs in the private sector last month.
Now, to put that number into perspective, just look at this. Forecasters were expecting something way up in the range of 70 or 80,000 jobs. So, 22,000 isn't just a little soft, it's a massive, massive miss. It suggests the labor market might not just be cooling off, it might be stalling out completely.
This all points to what economists are now calling a low-hire, low-fire economy. There are a couple big things happening here. First, companies, especially in tech, are using AI to get more productive without hiring more people. Second, a crackdown on immigration has shrunk the available pool of workers. The result? Companies are just hoarding the staff they already have, but they are not hiring anyone new. The job market is basically frozen.
And, this whole situation has left the experts totally divided. Just look at the huge range in what they're forecasting for when that official jobs report finally comes out. I mean, they're all over the place. It just goes to show that even the people who do this for a living are really struggling to get a clear read on what's happening right now.
So let's recap. We have no official data and a really confusing job market. Now let's just add another layer of complexity to the mix. At the exact moment we need a steady hand on the wheel, there's a huge debate going on about who should even be the pilot.
Right now, a major leadership change is underway at the Federal Reserve. The current chair, Jerome Powell, his term is up in May, and he's set to be replaced by the nominee, Kevin Warsh.
And this is not just swapping out one person for another. We're talking about a potential philosophical earthquake at the central bank. Powell is the traditional data-driven guy. Warsh, on the other hand, is pushing for a total regime change. He's arguing that AI has made us so productive that the Fed can slash interest rates to boost growth without even having to worry about inflation. It's a pretty radical idea.
And to make things even crazier, this whole transition is getting tangled up in political drama. Senator Tom Tillis is now threatening to block Warsh's confirmation, tying it to a totally separate investigation into Chair Powell. What this means is that the future leadership and the entire direction of the world's most powerful central bank is completely up in the air.
This leadership mess at the top really couldn't come at a worse time, because when we pull the lens back for part 4 of our investigation, what we find is an economy that's sending deeply contradictory signals. There's this growing split that makes flying blind even more dangerous.
At first glance, the big picture looks surprisingly good. Major forecasts say the US economy will grow at a solid 2.5%, which is actually better than a lot of our global peers. And yeah, inflation is still a little sticky, but it's not totally out of control. But that's only half the story.
Because when you dig into how consumers are actually feeling,
a tale of two very different economies emerges. The headline confidence number is at a 6-month high. Great, right? But that optimism is being driven almost entirely by wealthier folks who own stocks. For everyone else, sentiment is, well, dismal.
And this brings us to a really key concept for understanding 2026, the rich session. It's an economy where all those positive headline numbers are being propped up by the spending of a small, wealthy part of the population. The real danger here is that it completely masks a much weaker reality for everybody else, creating a huge blind spot for the people trying to navigate this thing.
Now for our final piece of the investigation. Let's bring all this abstract data right down to earth. What does a government shutdown actually mean for you? Well, if you're trying to buy a house, the answer is a massive headache. First off, the environment for home buyers is already pretty tough. The average 30-year fixed mortgage rate is stuck above 6%, hovering right around 6.29%. High rates are one thing, but this shutdown adds a whole new layer of problems.
So here's how the shutdown just squeezes the entire system. Lenders need to verify your income with the IRS. But guess what? During a shutdown, that office is pretty much closed. Thinking about using a government-backed loan, like an FHA or VA loan? Well, those agencies are running on skeleton crews. The whole mortgage pipeline just grinds to a halt. But here is the hidden trap, the one thing that can bring the entire process to a dead stop. And it's something that most people would never even think about. It's this. The National Flood Insurance Program is a federal agency. If the government shuts down, it can't issue new policies. And if you're buying a home in a designated flood zone, lenders require you to have flood insurance. So no policy means no loan, which means no closing. The deal is dead in the water, literally.
All of this leaves us with a final, really crucial question. We've seen how political gridlock can blind us, how confusing private data can mislead us, and how a leadership vacuum can just leave us adrift. So, in an age where these data blackouts might keep happening, what new instruments do we need to build to safely navigate the economic turbulence that's sure to come?